In this video, I will provide you with the most relevant aspects about the yield curve and its function as the most powerful and reliable indicator for economic downturns and recessions. Furthermore, I will analyze the current situation and derive options for action. Finally, I will show and explain why we are actually far away from an inversion, and I will show you which variables you need to observe. Welcome to www.investonData.com. We visualize data and dynamics on stock markets and help mid- and long-term oriented traders and investors to make smart and confident decisions in their risk management, strategy, and timing by leveraging a data-driven approach. What is the yield curve? The Treasury Department sells securities, bonds, which pay a certain yield and mature in a range from a few days to 30 years, providing a range of values which represent the yield curve. You will find that curve usually on a 2D plot having time on the x and the yield rates on the y-axis. The Federal Open Market Committee, FOMC, raises or lowers the short-term rates to control the economy by encouraging or discouraging money borrowing by consumers and businesses. Its goal is to keep the economy on a steady growth, not too fast and not too slow. Hence, it is one of the most powerful control instruments that directly impacts prices on stock markets, real estate and bonds, worldwide, and investors should definitely have an eye on it. What is flattening or inversion? The yield curve is considered as healthy when the short-term yield rates are lower than the long-term rates, showing a steep incline. A flat yield curve shows little or no difference in yields from the shortest-term bonds to the longest term. This indicates uncertainty and could result in any direction. An inversion of the yield curve happens when rates on longer bonds fall below those of shorter term, indicating that investors think massive economic challenges could lie ahead and shift their investments. An inverted curve is very rare but occurred prior to each of the recessions since 1950 except one case. This hit ratio is amazing. However, investors need to be aware that there is no consensus in which values to consider for the function as the most reliable recession indicator. In many cases, people refer to the spread between the 2- and 10-year rates, talking about the critical inversion, even though other parts of the yield curve may not be inverted. This approach worked pretty well in the past. However, the problem with that one is that it took up to 2 years till the indicated recession arrived. That is pretty much useless for traders and most investors. Other research shows that the spread of the 3 months and the 10-year rates is delivering a more reliable indication at a shorter time frame. That model is also used by the New York Fed, which calculates the probability of an upcoming recession. This is the model that is rather useful from my perspective. Current situation. Let's take a look at the current values and move to our macro dashboard. You will find 3 graphs here. The blue graph shows the yield curve as of today. You can read the actual rates at the corresponding index. The 30-year rate is at 2.6% as of today. The 3 months rate is 0.52%. As you can see, today's yield curve isn't downward sloping, but as the gray line indicates, which is the 1-week average value, it has been heading in that direction. What you also see is that the 5-year rate is already above the 10-year bond, leading to an inversion here. The spread between the 2- and 10-year rate is currently about 0.3%, which makes people nervous. However, the 3 months rate is more than 2% away from the other points, suggesting a positive economic growth for the upcoming months. The green graph named 10 mode provides you a taste of how a yield curve looks like in a bullish environment based on average values of the past 10 years. Having those 3 graphs on one screen, you can immediately see how far we are today from a healthy environment and in which direction the market is moving. In addition, you can see calculated values on the top of the dashboard showing the crossovers of the single rates. Those variables and their colors show you immediately how far or close we are to an inversion. Everything below 0.5 is considered as healthy and is colored green. Approaching the value of 1 means that we are getting closer to inversion, and the color will translate from green over yellow to red. At the bottom of the dashboard, you can see the major influence factors for the economy and the yield curve, such as GDP, inflation, and their change rates. Having that, you can immediately see where the risk is potentially coming from and act accordingly. So, what action could you derive from those learnings? Short-term traders and investors could derive that the market is still stable and the environment positive for trading and short-term investing. They also could notice that imperatives are changing. Rather selling big rallies instead of buying the dips. Long-term investors can see that long-term and buy and hold investments in growth equities require special attention. It may make sense to pause ETF savings plans or delay investment decisions if the macro variables are moving towards a bearish direction. Please note, a recession doesn't mean that all equities will lose. You may consider shifting your portfolio towards equities which profit in such phases. After all, this data-driven approach allows you to manage your emotions, which are frequently triggered by news, articles, and other sources. Who likes to read a boring article? Hence, journalists always try to catch attention and tend to emotionalize, and that has an impact on you and your decisions. This is why at the moment many traders and investors expect a crash or recession and draw expensive conclusions. Using data, you can avoid being influenced and derive action from clear and relevant information to position your trades or investments and adopt your strategy and risk management according to the market situation. It's all here, it's up to date, and it's instantly digestible. Thank you for watching. I would love to read your opinion, your questions and requests for future topics below. Please give us a thumbs up if you liked that video, subscribe and hit the bell for weekly updates and further educational content. Please note our disclaimer. All information we provide is created and shared for educational purposes only. We are not certified to provide investment advice and do not provide any